Welcome back. Today we're going to talk about financing a business and the options of debt versus equity. If you recall from a previous segment, we looked at a balance sheet in great detail because we looked at Mattel's. What I've put on the board behind me is a very simplistic balance sheet as well as an income statement. Now, a balance sheet, if you'll recall, is a snapshot at one moment in time. It lists all of the assets, the things that a company owns, all of the liabilities, the things that a company owes, and the difference between those two figures represents the stockholders' equity or their investment in the business. A balance sheet has to balance. The total amount of assets has to equal the total amount of liabilities and equity combined. Now, in our scenario, we're trying to decide, should this business borrow additional money or should they sell additional investment to other shareholders in order to raise the capital that they need to buy additional assets? You're looking at a snapshot in your assignment. You don't even see the asset side of the balance sheet. You don't really need to for our purposes, but you know that the total amount of assets is equal to whatever the total amount of liabilities and equity are. Now, additionally, you're going to want to keep in mind the income statement. The income statement, which I've summarized here, lists the sales or revenues, and these two terms are used interchangeably. It used to be that sales referred to tangible goods like toys, revenues referred to intangible things like services from a law firm. You're going to subtract the cost of goods sold. That leaves you with the gross profit. Then you'll subtract other operating expenses. That leaves you with something called EBITDA, earnings before interest, taxes, and depreciation. Particularly when a company is making a financing decision, it's important to break out these specific expenses. If you're thinking about financing, you need to know how much interest expense will we be spending. Depreciation, we're not really going to get into in terms of this example, but if you recall, depreciation is the amount of money that we are reducing our fixed assets by, the equipment perhaps that we've bought each year, to reflect the fact that those assets are in use. Depreciation as an expense reduces our overall income and thus reduces our taxes. So by being able to declare depreciation, even though it's not an actual monetary item, it reduces our taxes, which saves us real cash and helps us recoup some of the money that we spent on those fixed assets. So depreciation is a positive in that sense. All right, coming back, after we subtracted our interest and depreciation, we have our pre-tax income, and then we have our income taxes and our net income. Now, in our particular scenario, we have to decide, should the company borrow additional money, which means that then they would have additional interest expense, and they would thus pay lower taxes because they'd have lower income, or should they sell additional equity? Now, in your scenario, what you would do is, you would say, in the first scenario, let's only consider borrowing additional money. So you look at the position they're in now, what debt they already have, add to that number additional debt. Then take that new debt figure and multiply by the interest rate so that you can calculate the interest expense. Assume that sales and other expenses haven't changed, but because you now have higher interest, you're going to have lower pre-tax profit. You're going to then calculate the new taxes using the tax rate and the new pre-tax profit, and you'll have a net income number. You're going to look at that net income number and divide it by the total amount of stockholders' equity, which is unchanged in this example because we haven't brought in new investors, we've only borrowed additional money. That will help you calculate the return on equity. You're also probably going to want to calculate the debt to equity ratio. If you remember that, it's a leverage ratio, and it shows us how much money a company has borrowed relative to how much the owners have invested. So to calculate debt to equity, you're going to take the total liabilities, which is now higher because of the new additional debt, and divide by the equity, which has remained unchanged. Put that aside. You've got a debt to equity calculation and a return on equity calculation and a new net income figure. Now you're going to do another scenario. The second scenario, you're going to pretend that the company has not borrowed any additional money, but instead has sold additional shares of stock at the price stated in the example. So you're going to add additional equity here. Now, in a real-world scenario, the equity category would be a little broader. It would show the additional shares of stock at their par or face value. It would show any sales of stock above that amount. So if a company sells a share of stock for $10 and the face value is $1, they would put $1 into their par value account. They would put the additional $9 into an account called additional paid-in capital. And then there's a third account in stockholders' equity called retained earnings, which is where the company reinvests any profit that they have in the business. But to keep this example and this assignment simple, we're just having one category for stockholders' equity that reflects any investment by the stockholders. So in your second scenario where you're looking at equity, you're going to put into this equity column an additional amount of money reflecting additional shares sold. Now, you're going to come back to your income statement. By selling additional equity, will anything change on this income statement? No, because we're not going to have any increase in interest expense. It's not going to affect our sales. It's not going to affect our taxes. So our net income number is going to remain unchanged from the way it was at our starting point. So now you're going to take your net income number and again divide by stockholders' equity, only this time the stockholders' equity account is a larger figure than it was in our debt example because we've increased the equity. So you're going to have another ROE calculation. You're also going to calculate debt to equity. Your debt is unchanged in this scenario because you're not borrowing additional money, but your equity number is larger. So now you have several sets of facts which you want to compare. Scenario A and scenario B. You want to look at the debt to equity ratio in both scenarios. You want to look at the return on equity number in both scenarios. You perhaps want to look at what net income is. And then you want to make a recommendation. Should this individual borrow additional money or should he sell additional equity? If he borrows additional money, he's going to have greater interest expense. He's going to have a lower net income, but it might positively affect his return on equity. In other words, he's using someone else's money, the banks, the creditors, leveraging that so that he will get a better return as an investor. If he decides to sell the shares, he's giving up some equity and some control perhaps to some other entity. He may have a lower return on equity, but he may have a higher net income number because he doesn't have the interest expense and he doesn't have the concern that he'll be able to meet future debt payments. So your task is to plug in those numbers, calculate the return on equity, and calculate the debt to equity ratio as well as the new income number in two different scenarios, and then to make a recommendation as to why you think he should either borrow the additional funds or he should sell additional shares of stock and bring in a new investor. I hope that makes this a little clearer. I look forward to seeing your results. Thank you.